We begin the show with Bloomberg's Rachel Adams-Hurd, Sonali Basak, and Lisa Lee. Let's start with those bankruptcies, which are picking up among U.S. oil producers. Bonds of the companies have gotten absolutely pummeled. Some see this as an opportunity, others showing signs of concern.
It's been obviously a horrible sector to be in for the last year. I mean, it's really hard to find something that isn't scary.
The amount of capital available in the oil patch is disappearing. We're seeing deals in the oil patch that are dramatically better for the investor than anything we've seen in the last 10 years.
Retail and energy really lead the way in terms of the quantum of opportunities over the last 5 or 6 years, and we think that's going to continue.
Make no mistake about it, just because it's not going good as an industry. When I bought the Cowboys, they were losing $1 million a month. The industry was ostensibly going down.
Yes.
The industry does not in any way dictate the promise of the individual or company in the industry.
I think people still look at that as catching the falling knife. I'm not sure anyone thinks that we're kind of bottoming out there yet.
Do you view that as catching a falling knife?
We do today. We're not spending a lot of capital there. I think we look at that as there will be an opportunity. I don't think that opportunity is or pressure to do something right today, right now.
Rachel, for those who are diving in, what's the logic?
Well, I mean, I think right now public debt and equity markets are effectively closed to this sector, and it's a very capital-intensive industry. Investors were told quarter after quarter that free cash flow positivity was just around the corner, and for the most part, that hasn't really materialized in a meaningful way. So now you have these assets that could theoretically prove some upside value, especially if you think that things are going to get better either on the oil side or the gas side, and there's just no money left in the public space to really pursue those. So if you are Sam Zell, if you are Jerry Jones and you're seeing that, now would be the great time to come in, as long as you do believe that things are going to get better on the market side. And
Rachel, are they going into the hard assets? Are they going into the debt? How are they playing this? Do we have a sense?
It sounds like from Sam Zell's venture, what he did last time was he looked and he did what's called a drill co with California Resources. So that's basically what amounts to a joint venture. This time it sounds like he's buying up assets directly, and he's looking at the actual producing assets. So he's skirting management teams. He doesn't want to mess with overhead costs. He wants to own the assets directly.
Well, that all brings us to the cash that's behind this right now. And that is really absolutely an amazing amount the private companies have raised, and it needs to go somewhere. Sonali, we've gotten a slew of reports over the past week over just how much cash is being added to the already high levels of dry powder. Can you give us a sense of the latest there?
So the latest is that a lot of the cash being raised, which is surprising because you have investors like Sam Zell who are going direct, a lot of cash is being raised by these private equity funds into many strategies. So what is that? That's Europe, that's Asia, it's real estate, and it's venture. Actually, you have a lot of these companies going into venture. So it is broad-based, it is across the board. You have Blackstone wanting to hit $1 trillion in assets, record amounts of fundraising in general, surpassing their 2007 highs, and then you have Apollo as well wanting to nearly double their assets in the next 5 years to $600 billion.
And it is really specific to private equity, not so much hedge funds, and perhaps a little bit to private credit, correct?
Correct. There's still money going into private credit despite some concerns about the valuations and the frothiness in the market, because guess what? You have all of these public investors that look at the public markets today and say, this is volatile. We don't know where to go here, and there's also less companies for us to invest in these days.
But there's volatility in private markets too. If it's not liquid, doesn't mean it's not volatile.
It's volatile, but presumably the volatility is a little bit less. A public market investor told me, and when I asked them if they were afraid about the illiquidity, they said, we feel like we've learned from the last crisis. We think we know how to play these markets this time around so that we're not losing money in a big way the next time that the markets go down.
All right. Well, with all this money brings reputational risk. The U.S. House of Representatives is holding a hearing called America for Sale, an examination of the practices of private funds.
There are far too many examples of private equity firms destroying companies, preying on hardworking Americans to maximize their profits.
Lisa, is this just a direct result of all of the funds that have been raised for private equity, or something else driving this sort of public inquiry into private equity?
Well, definitely having 1.6 trillion of assets that private equity holds matters. But what's really changed the narrative, especially in Congress, has been the retail bankruptcies led by Toys R Us. 10 of the last 14 of the biggest retail bankruptcies since 2012 were PE backed. And in Toys R Us, you saw more than 30,000 people lose their job because it wasn't a bankruptcy where the owners just changed hands, it was a liquidation. And that has brought so much focus into private equity's practices of levering up companies. And as the world is going through secular change, whether it be automation or technology or consumer preferences or globalization, when you have lots of debt onto a company, it gives them less room to maneuver.
Yeah, and meanwhile, it's not just retail, because also in a post on Medium.com, Senator Warren writing, some of the same Wall Street firms that tanked the dream of home ownership for millions of American families are now the country's biggest landlords, profiting off the destruction they caused. She was going after Blackstone and Cerberus, among others, saying that they bought up a lot of rental companies. What has been their response to this?
Well, they've said, no, we do not boost up rent, because if you look at the neighboring areas, we own a very small portion, and we charge equal rent as everyone else. So they're saying that we are actually helping, and we're taking houses that are dilapidated and need to be fixed and turning those around. But even in the congressional hearing, one of the congresswomen pointed out that when a private equity firm bought a communities sector, they raised up rent 20 to 70%. So it might not be everyone, but there's definitely a perception that private equity is really hurting the average American worker.
What's the potential consequence for private equity as an asset class that Democrats in particular are going after it as the sort of whipping boy, frankly, of the entire election cycle?
Yes. So probably this Congress, nothing will happen. They only control the House. But we have an election coming up, and that could change. But even, let's say, the Democrats don't take over the Congress and the White House, there could still be repercussions. For instance, carried interest has always been a loophole that private equity has somehow managed to get off the chopping block, and it still exists. With the narrative saying that private equity might be job destroyers instead of creators, you can see that change.